Folks, you got to be flipping my flapjacks. Look at Palantir stock, a new all-time high here today for Palantir stock. ELF up another shocking 5.5% here today, new 52-week high. Congratulations to all Palantir and ELF shareholders out there. Unbelievable. SoFi just hit a new 5-month high. That stock was up another 4.6% here today. Fubo up nearly 3%. That stock's up about 98% in the past 6 months. Such a ridiculous number. I had to fact check it. I'm like, wait, is that right? 98% in the past 6 months. Meanwhile, the stock market here today was down, down, down. And you could have been in Chinatown eating lo mein, and you could have been making money left and right in some of these other stocks out there, right? Meanwhile, you got Besson out there floating the idea of extending the tariff pause. Oh boy, okay, with countries acting in good faith. We'll speak about if this is good for the market, bad for the market, and where, this whole tariff madness, how all this is going to end up playing out in the end, okay? Jamie Dimon, it's getting a little strange. Jamie Dimon came out again today and warned of the U.S. economy could soon deteriorate, right? The man in charge of the biggest financial institution out there, what is he saying, okay? So we're going to get into what he's actually saying here and, the strangeness of this whole situation, okay? AMD. 1 minute ago, I posted this on X. I'm not sure if you guys follow me on X or not, but if you ever want to follow me on X, if you use that platform, you can certainly do so. It's always linked in the description area of all my videos on this channel, okay? But I put this on X a minute ago. It looks like 500 people have already gotten to see it. I said AMD to $200. Question is $200 in a few months or $200 in 2026? And so in this video, I'm going to share my opinion on when I actually see AMD going to $200 plus. Right now, the stock's up around 120. Everyone needs to take some profits on 2 stocks this summer. Very specifically 2 stocks, okay? These stocks are very popular. They're in major hype cycles right now. I'm telling you, if people do not take some profits on these 2 stocks this summer, they will look back, in my opinion, a year from now, a few years from now, and be, let's just say have a lot of regrets about not taking some profits, because you're getting a great opportunity to take some really attractive profits this summer on a couple stocks. And so we'll speak about that, okay? 32-month bull market. We've basically been in a bull market for about 32 months now. Now, we've had plenty of dips, corrections, pullbacks along the way, right? Including the massive one kind of, end of February into the beginning of April. But being that we've kind of been in nearly a 3-year bull market, when is the right time to hedge? I'm going to share that with you in this video. When does it make sense to buy put options to hedge your portfolio, okay? Additionally, I will be buying stocks on Friday. So in this video here today, we're going to talk about what type of stocks I'm looking at buying on Friday in this market, given everything that's going on out there. Okay, one thing and this one thing only I need from you guys for an action-packed, busy video like I'm doing here for today for you guys. Smash a like button on this video. That's it. I hope you can do that for me. I appreciate you doing that for me. The 10% of people that do that for me, I appreciate you guys, okay? And for the other 90%, if only I could get a few more percent of you 90% to smash a like button, it would mean so much to me, okay? I appreciate y'all for being here. Additionally, if you want to subscribe to the channel, you can certainly subscribe. We are now over 860,000 subscribers here on the channel. Oh my gosh. Now, I'm going to talk about what stocks I'm likely going to potentially buy on Friday, but if you ever want to track the stocks I'm buying and selling each week, you can always join my Patreon. It's linked in the description area of all my videos. I don't really shout it out very often. It's also, I'll put it as a second pinned comment down there today. It's $33 if you want to join it. If you want to pay on an annual basis, you can save 16%. But basically, that's the ability to see the stocks I'm buying and selling each week in that portfolio, and the ability to be part of a Discord chat, the Market Hours Discord chat as well. So if that's all you're looking for, you can certainly join there if you want. Now, if you're looking for something much more in depth, if let's say you're somebody let's say you're watching this right now, you've got $50,000 plus in your portfolio, you might want to apply to join a private stock group. That's a much higher level group that has very in-depth course curriculums covering a lot of in-depth, complicated subjects, hedging, running portfolios properly, diversification, a lot more, let's just call it higher level stuff. You're also around a higher level group of investors. Like the average net worth of somebody in my private stock group, I would say probably $500,000. Now, we got people in the private stock group that maybe have, $50,000, $80,000, $120,000 net worth, but we've got a lot of people in there that are millionaires, multimillionaires as well. So if you want to be around a higher level of group and high-level course curriculums, all that good stuff, and be able to see the stocks I'm buying and selling my $3 million plus Fidelity account. That will be the main pinned comment down there, the very first link down there. Second link will be if you're looking to just join the Patreon, okay? Alrighty, so let's get into this. Bessa. Well, is this good or is this bad for the market? I'll put it to you like this. Flexibility. Flexibility is a term that comes to mind when I think of this. If we go back to the pure fear that was in the market that was causing hedge fund managers, portfolio managers with hundreds of millions of dollars under assets, billions of dollars, tens of billions, hundreds of billions of dollars to sell. And let's be very clear, that's who was putting all that selling pressure. You don't get all that selling pressure unless big money is hitting the sell button left and right? Meanwhile, retail, we've been able to see the data, retail came in and bought stocks left and right during that whole major correction we had in the market, right? But it was a fascinating time because you were looking out there and you're like, oh my gosh, like all these fund managers selling, but why were they selling? Because they believed that there was no flexibility in regards to this tariff stuff. Now, were they wrong for believing that? Yes and no. If they had paid attention to Trump's first presidency, Trump actually showed he has a lot of flexibility. He has a lot of bark, okay? He has a lot of bark. He says he's going to do this and he's going to lay the hammer down and this and this and this, but he actually has a lot more flexibility than he gives off. And if you were around and you invested in the first term, you saw this firsthand. I saw this countless times with Trump in that first term, right? So when he came out and he had the whole, tariff day that we all remember, right? People thought, they were under the assumption that there was no flexibility here. The 100 and whatever % tariffs on China were going to stay. All these countries and the reciprocal tariffs, that's all going to stay. And there's no flexibility. And what we're seeing now is there's a lot of flexibility here. There's a lot of flexibility in regards to when deals could get done, the dates those deals could get done, what rates are going to be, what products and services are going to have these sorts of rates on them. There's a lot of flexibility here. So if this is no stiff as a board situation, it's my way or the highway, there's a lot of flexibility here now at this point in time, right? Now, on the flip side, the market's definitely looking at this as a positive right now, right? But I will say this is going to end up developing into a hangover over the market, an overhang on the market essentially. And it's going to take time for it to go from like glass half full to glass half empty, but that will happen as time stretches on here because the market will start to eventually get impatient. And then we know Trump can only stay out of the drama for so long, and we know eventually he's going to get back into it with some of these countries. You know that's coming, right? It's just a question of how many weeks or months from now is that in regards to that. So this will remain kind of, in my opinion, overhang on the stock market in general. Now, listen, I got to be honest with you guys. This is really good news. The fact that there's so much flexibility here, it's really great news for very certain stocks. And I'll give you an example of a stock this is great news for a particular stock, and that is Elf Beauty. Elf Beauty is the perfect example. Elf Beauty, what did Elf Beauty get down to in that major correction in the market? Did Elf get into the 50s? I think Elf got into the 50s in that major correction, right? Yeah, it did. It got all the way, it got into the 40s at the very lows. $49 a share it got down to, right? It's up about 150% since those April lows. That's crazy. That was less than 2 months ago, by the way. When it was hitting these lows, that was less than 2 months ago, and it's up 150%. But Elf Beauty is the perfect example of a company in which, everybody looked at it and they said they're doomed. Like they're going to have this 100 and something % tariffs on China, right? And if you just thought logically about it, you're like, that's not going to likely stick. And Elf's already announced they're going up on pricing. I think they mentioned around $1 a product, which I always told you guys, what I always tell you in regards to Elf, I said they can go up on their customer base $1 easy. It's not going to magically make somebody say, I'm not going to go get my primer because it went up $1. No, okay? They're going to still go get that product at Walmart, Target, Amazon, wherever. Because it went up $1 is not going to magically change the story. Like Elf's products are very high quality. They're known for being very high quality for very cheap prices. And they make amazing dupe products, they call them, okay? And so at the end of the day, like Elf is the Perfect example of a company that benefits tremendously from this real flexibility we're starting to see in the administration in regards to these tariffs and these deals and these trade deals and all those sorts of things, okay? Now, Jamie Dimon, oh my gosh, warns the U.S. economy could deteriorate. What is he actually saying? And by the way, I think it's worth mentioning a couple things. This is not the first rodeo Jamie Dimon's had in regards to worrying people around the economy and those sorts of things. He's done this before. He did this, a matter of fact, even back in 2022. You could listen to him talking about, actually, I think it was the beginning of 23, either end of 22, beginning of 23. He was talking about storm clouds and this and that, right? And so this is not the first time he's done this, but he's been doing it, seems like, a lot very, very recently. But keep in mind, he leads the biggest, most important financial institution in the world. In the world. If you look at JP Morgan's market capitalization, it is over double the next most important financial institution in the world, which is Bank of America, which speaks volumes to how powerful JP Morgan has really become in the financial markets. And so when you're somebody like Jamie Dimon, you've got to lead. You've got to lead with a sense of concern, of worry, because you're looking out for your shareholders, you're looking out for the American economy, in some ways the worldwide economy, with how much business JP Morgan does around the world. And so he needs to be actually pretty cautious overall, because if a man like that is too optimistic, he could lead his company into big financial troubles, which could then spell into major financial troubles for the whole stock market, for the whole American economy, for the international economy. So that is worth mentioning. But what is he actually saying? Here's what he's saying, okay? The impacts of the Rona-era government spending and monetary policy that helped support the U.S. economy have faded, and that makes the country vulnerable to a downturn in the coming months. Listen to that term, in the coming months. He didn't mention in the coming years. He didn't say in 10 years from now. No, in the coming months, he says, okay? According to JP Morgan CEO Jamie Dimon, quote, "I think there's a chance real numbers will deteriorate soon," Dimon said at a Morgan Stanley conference on Tuesday, according to a transcript from FactSet. So, sometimes these things are done a little behind closed doors, obviously, but stuff ends up leaking out when it's all said and done, and then you hear what these people are actually saying behind closed doors, and this is what Jamie Dimon's saying literally behind closed doors, right? The U.S. has continued to see growth in total employment and consumer spending this year, even as survey data has shown weakening confidence in consumers and business leaders in the face of the Trump administration's tariff policies. Dimon downplayed the survey data, saying that, quote, "neither consumers nor businesses ever picked the inflection points." I can't debate that. But said the economy's soft landing was likely to look weaker going forward. Quote, employment will come down a little bit. Inflation will go up a little bit. Hopefully it's just a little bit, he said, adding the lower levels of immigration is another thing complicating, no doubt. The whole immigration situation is definitely throwing a wrench in everything. Because you can look at this one way and you can say, okay, and I'm sure you guys have seen the videos of ICE, going to, warehouses and out to, even I've seen videos of them going out to farm fields and arresting, people that might not have their papers right? And, okay, so that's happening a lot around the United States right now, right? So, obviously that's a big disruption that's going on, right? Certainly for those people that are being arrested and deported or whatever the situation is there, right? That's a mess for those people. But then they're not going to spend in the economy, right? Because if they're getting kicked out of the country, like all that spending that they were doing in the U.S. economy is not going to be going on in the U.S. economy anymore, right? Now that also sits some of these businesses, like I saw a video today even of, it was some sort of like food processing facility where I believe they arrested around 100 at this facility, right? Now that facility needs to fill 100 positions because they just got arrested by ICE, right? For this food facility. Okay, you're just going to be able to go get 100 workers that easy? Unemployment's pretty low right now, right? So that's going to be a major disruption to just go fill those 100 jobs. And guess what? You now want to try to get people that are citizens, for sure citizens, to fill those positions, my hunch is you're going to have to pay them more money than what you were paying the people that were not legal citizens. It's just common sense. So which means your cost of doing business goes up, which means you end up eventually having to pass that on to the consumer. If you can't pass it on to the consumer, you're going to go out of business. So it's a disruption. And it's, I don't know how all that's going to work out, but it is a risk factor that should be definitely considered out there. I think is very, very important. Another area that Diamond warned was private credit, which has become a booming business on Wall Street and is seen as a potential area of concern in the event of a recession. The CEO explained that the risk of private credit are different for banks, which line up the deals and then move them on from their books, and for investors looking for long-term results from this asset class. Quote, "Do I think that now is a good time to buy credit if I was a fund manager? No." That's interesting. "I wouldn't be buying credit today at these prices and these spreads," Diamond said. Wow, big statement here. So the banks are they're running a little asset light when it comes to private credit. They may facilitate the deals and make a bunch of commission dollars off that, but they're moving them off their books, and the investors taking the risk of that. Now, and when I say the investors, I'm talking about basically outside investors, not like necessarily, because if they're moving them off their books, then it's not like JP Morgan shareholder base or these other banks' financial shareholder bases. They're not really taking the risk. It's whoever's actually buying that private credit, which is, done elsewhere. And so, if that does emerge as a problem, there's going to be a lot of investors that lose a lot of money because there's been a lot of this private credit stuff going on out there. And it doesn't get talked about a lot, but the numbers are staggering. When you look into how much is going on in private credit right now, it is a risk factor. And you always got to keep in mind, whenever you have some sort of crash scenario, something that really brings the cards crumbling, it always comes from somewhere weird. Like if you look at the great financial crisis, it came from these derivative contracts, right? And, Warren Buffett and I think some others coined them as financial weapons of mass destruction or something like that, right? But from these derivative contracts that a lot of people weren't even familiar with, right? And then you looked at the basket of the homes they were putting together and a lot of stuff that, if you were like really, really in the know, you knew about some of the stuff going on, but 99% of people, if not over 99% of people, had no clue what was going on in the derivatives market and when things started to go the wrong way, it got ugly very, very fast, right? And the financial markets really seized up and dried up. And so, if you look at where could something like this come from, I mean, this private credit situation, if that was to go bad, I don't know, man. Now, if you want to go tinfoil hat, because I know people always like to bring it back to politics, and they have these theories on certain political parties want things to go bad at certain times and whatnot, right? Well, if we want to go a little tinfoil hat here, right? Midterms are next year. Now, we know the Republicans are in charge right now, right? No question about that. So if you're the Democratic Party, like if you had to pick a year you'd rather have a recession, because everybody was thinking like we'd have a recession this year, right? And as years going on, more and more people are like, I don't know about this recession this year, right? If you had to pick a recession this year or next year, what year would you pick? If you're the Democratic Party, you'd much rather have a recession hit next year, wouldn't you? Of course. Why? Well, midterms are next year, right? If we had a recession in 2025 and then it gets over next year, by the time you get to the actual election, everybody's going to have forgot about it and moved on with how fast the news cycle and things move on today. So if anything, you'd rather have a recession hit next year, right? And then when people go to those polls, they're going to look at the Republican Party as you guys are the problem, right? If you look at the balance of power in the House right now, Republicans are in control by about 7 seats, it looks like. Balance of power in the Senate, Republicans are in control by about 8 there. So, we'll see what happens. But, if you have a little tinfoil hat, definitely people with certain individuals would like a recession next year, right? It would definitely be better for them, right? Now, AMD. What's my opinion in regards to AMD and when this stock actually hits $200 a share? Well, we have some big news that came out after hours. Oracle stock's up pretty big after hours, up over $12 a share after hours. Now, what happened with Oracle is the company beat on earnings per share, good. but nothing crazy. Company beat on revenue, good. Nothing crazy, about $400 million beat. The big part of what transpired here was what I basically, highlighted here. Cloud infrastructure revenue should increase more than 70% in 2026 fiscal year, up from growth of 52% in the quarter. So they're seeing an acceleration of growth in cloud infrastructure revenue, okay? The CEO of the company, Katz, said in a conference call with analysts, she called for more than $67 billion in fiscal 2026 revenue compared with what consensus was at about 65. So we're talking nearly a $2 billion beat there. Looking out further, Oracle will likely exceed the $104 billion revenue target for fiscal 2029 that it provided in September, the CEO said. The moral of the story is here, Oracle's cloud infrastructure business is doing a lot better than expected. And these markets are growing rapidly, which means you could see even stronger numbers from kind of Google Cloud and AI and what they're doing there. You could see a lot stronger numbers from AWS. You could see even stronger numbers from Azure, from Microsoft, right? So now, at the end of the day, how is all this infrastructure getting built? They're getting built on the back of what? Massive quantities of chips. They're having to order massive quantities of chips from NVIDIA, we all know, and AMD really starting now, right? Now, my opinion with AMD is seeing these results from these companies, right? And then seeing the results from next quarter from these companies as well, I think they're going to finally get it, right? And we know the big AMD day is tomorrow, and I'm sure I'll cover that either on the main channel or I'll cover that on the reaction channel, right, in the next 48 hours. But I think they're going to start to get it. Who do I mean by they? I mean Wall Street. I think they're going to finally start to get this one and understand why MI 350 is going to be so big, why MI 400 is going to be so big, right? And in regards to what happens tomorrow, they're supposed to give some details on, obviously they'll talk about MI 350 and what's going on there, but MI 400, which is going to be the next level kind of game change for the business model for AMD overall, right? Now, when you look at AMD, the company's trading way too cheap. 35 forward P, I think they're going to smash numbers over the next year. So that 35, I think, is way lower than that in reality. 2-year forward P at 21. Once again, I think the following year they're going to also destroy analyst expectations when it comes to earnings per share. So I think that number in reality is way lower than it is. But even at 35 and 21, it's way too low considering AMD's growth rates in what their trajectory is to grow this business over the next 5 years. I'm not even talking 10 years from now, 20 years from now. I'm just talking over the next 5 years. This is way too low of a valuation for AMD right now, which means I think AMD is going to 200 sooner rather than later. A lot sooner. And I think they will get this, right? Now, additionally, retail has a history, a very strong history. And when I say retail, I'm talking about average Joe investors, whether you're the guy that's got $100,000 in your portfolio, whether you're the guy that's got $10 million in your portfolio, right? Retail has a history of beating Wall Street to opportunities. We know this. It happens continuously. Two great examples in recent years are Palantir and Tesla, right? The retail investor base understood Palantir before Wall Street understood Palantir. That's why a lot of us, like myself, was buying Palantir left and right at $7 a share, right? And now Wall Street's out there bidding this stock up at 130. I saw Wall Street buying the stock at 137 a day. A few years ago it was $7. Retail, we saw it before Wall Street saw it, right? Tesla, another great example. You look at somebody like myself. I was buying Tesla shares left and right back in 2019, right? I saw Tesla's future. I'm like, this has a lot of big opportunities, this, right? We saw the future. And, back then, the market cap on Tesla was like a $50 billion market cap, right? Wall Streeters today are willing to pay $1 trillion for that company. $1 trillion, right? So we have a history of beating Wall Street to these stocks. And AMD, we're all very excited about this stock. We've been buying it heavy over this last, 6 to 12 months, right? And I think we beat them to the punch again. And I think they're going to recognize AMD. And as AMD's numbers get stronger as this year goes on, that's just going to give more proof that AMD's the stock to own. And we'll see 200 much faster than I think a lot of people are anticipating here, right? And that's just building upon there. So it's going to be fun next few years, in my opinion, in regards to AMD. Now, speaking about certain stocks, everyone needs to take some profits on two stocks. These are very popular stocks. They have a lot of hype around them, but people need to take some profits this summer, man. Take some profits this summer. Mr. Market is giving you a phenomenal opportunity to take some profits on a couple stocks this summer, okay? And I know some people don't want to take those profits, because, there's so much hype and excitement around these companies right now. But let me say this. The hype and excitement doesn't last forever. These hype and excitement periods, they last, but for a little bit. Like sometimes it's a few months, sometimes it's a year or two, but then it fades. And then you start to slowly have a little less hype and a little less hype. And as that hype falls down, the stock falls down immensely. It's not a small amount. And so what are these two stocks? I hate to say it, but it's Tesla and Palantir. Two of the stocks that I've profited from the most, over the past number of years, right? Two stocks I made ridiculous gains on, ridiculous sums of money on. But I have to be honest with you guys, these are two stocks that are ripe to take profits on this summer, especially if this market continues to roll risk on and people are just willing to pay anything for these stocks. You got to take some profits this summer, man. You got to take some profits. The PE ratios are out of control in regards to both of these stocks. Now, in a hype cycle, you got to understand PE ratio doesn't matter, but this hype cycle will not last forever. Maybe it's got a few more months left. Maybe it's got a month left. Maybe it's got a few weeks left. Maybe it's got a year left. I don't know. But the hype cycles don't last. Then reality comes crashing down, and it comes crashing down hard, right? And I've witnessed these stocks go through hype cycles. Like people weren't around, I'm sure there's plenty of people watching this video right now. Were you around for Palantir's first hype cycle? I hope you were. Some of you guys watching this video, you weren't around for that first hype cycle. The first hype cycle around Palantir stock was back in 2021. Stock went to $30, $40 a share or so. That hype cycle went away. Palantir numbers started to slowly deteriorate. Not like the company stopped growing. They still kept growing. It's just their numbers started to get as exciting. And the stock fell to $5.98 from $30 to $40. The hype, it died down. And that's what happened to the stock. Tesla stock goes on just a ridiculous run from 2019 into 2021, beginning of 2022, right? Oh my gosh, so much hype, so much excitement. Tesla's putting up amazing numbers, obviously, right? Like extraordinary numbers in regards to their growth rates. Tesla stock goes from, a stock that pre-split was like a $13, $15 stock, all the way to $400 a share. Unbelievable. A lot of us investors made life-changing money, game-changing money, right? Insane. Incredible. And then Tesla stock at the lows in 2022 went down to right around $100. Stock fell around 70%, a little over 70%. So right now we're in a very exciting hype cycle in regards to those two stocks. Whenever this hype cycle goes bye-bye, those stocks will go through a major downfall. There's kind of two things that could happen. One is a major downfall where the stocks crash 50 to 90%. Another situation is the stocks just don't really do anything for years and years. And maybe they go up, they go down, they go nowhere. Tesla has a history of doing that. It's actually done that. If you look at Tesla for the last number of years, it's done exactly that. You look at Tesla, you could have bought this stock for $400+ back in 2021. The stock's lower than that today. So, and you're looking at the stock today, I wouldn't be surprised if it's a lot lower 2 years from now than it is today. And you look at Palantir, Palantir's in, amazing hype cycle right now. Who knows where it ends at? Maybe it goes to 150, 180, 200, who knows? But after the hype cycle slows down and dies, right, the stock's going to have a big downfall. And it's going to be painful for a while, for quite a while, in regards to that stock. And so you got to look at these stocks and you got to understand, got to take some profits this summer, man. Tesla. Everybody's so excited about robotaxi. Oh my gosh, robotaxi is going to be this big thing, man. I was a shareholder of Uber in the past. Obviously, I was a Tesla shareholder for a long, long time, okay? Let's say hypothetically, Tesla can be as big as Uber is. Now, there's a big question about that. Uber is a worldwide famous name with people know if you need to get a ride somewhere, you take an Uber, right? And they have a competitor in Lyft, and they have a few other competitors in other markets. But at the end of the day, the masses, if you need to go to get a ride to the airport and you don't have a friend or family member, you're booking an Uber, right? Worldwide famous name, huge market share. If Tesla became Uber, right, which keep in mind, a lot of Uber's valuation is also in Uber Eats, which I don't know how Tesla's planning on doing that because, They're not going to have humans in the cars. So I don't even know if they'll ever be able to do a food opportunity there, or at least anytime soon, until they get the robots to work at some point in the 2030s or 2040s or something like that. So if you look at Uber's entire market cap, it's around $180 billion. So if Tesla becomes as successful as Uber in the next 5 to 10 years, which is a big question if they can even pull that off, but if they did, you're talking about a $180 billion opportunity. It's not as exciting as it seems. Now you can say, what if not only they became as successful as Uber, as big as Uber, as dominant as Uber, but additionally, they became twice as profitable? You can say, well, these robotaxis are going to make so much more money. They're going to be so much more profitable. There's a debate if that's even going to be like that, but let's say it is. So they make twice as much profit. Then you're adding about a $360 billion number to Tesla's market cap, right? But here's the problem. It's already priced in more than that. When we look at Tesla's valuation, the valuation of Tesla is over $1 trillion, right? I'm assuming you would assign about $200 billion for the auto business, considering like how big the EV business should be 5-10 years from now, which, the growth rates have been awful really recently in regards to that business, actually in decline. But let's assume like it's just a fluke. EVs are still the future. They're going to grow. They're going to become this big thing. Then you could assign about $200 billion of value to the auto business. Then you could assign, and this one's a real stretch, $200 billion into services. And so when I talk about services, I'm talking about the supercharger network. I'm talking about problems that happen with Teslas, right? I'm talking about the fancy maps feature that I pay an extra $10 a month for or whatever in the Model X and the Model S of mine, right? All that type of stuff. So you assign another $200 billion there, which is a big number, but let's say you want to assign that. Then you could assign $200 billion to energy business. Energy business is so small, but you say maybe it grows a lot over the next 10, 20 years, becomes a much bigger business. There's actually, I think there's a overall move away from a lot of sustainable energy that I'm starting to see out there, but let's say, that's just a fluke as well. It's still this next big thing over this next 10, 20 years. So you assign about $200 billion of value to the energy business. That means you assigned over $400 billion to the robotaxi business. And the only way that business is ever worth $400 billion is if they become Uber and they become twice, if not more than twice, as profitable as Uber. Now, there's a risk that they never become Uber, and there's a risk they never make as much money as Uber, and there's a risk that they never become 2x more profitable than Uber. And those are all risk factors you have to assume. So Tesla is priced in the best case scenario. And so if you're buying Tesla today, understand you're already buying it assuming they already did all the stuff. Now you may say, well, where's the valuation for the robot business? Listen, man, the robot business is not going to matter to the 2030s plus. Trust me on that. The 2030s plus, then you can maybe talk about that eventually some sort of meaningful business. Maybe 10, 15 years from now, maybe it's some sort of meaningful business for Tesla. But it's not, I can tell you, it's not going to be any sort of meaningful business this decade in the 2020s, right? So, look at how long it's taken them just to freaking get the robo-taxis. Like, people are all excited about, there was a robo-taxi driving around in Austin the other day, and they're all excited on X. Dude, Elon's been talking about this robo-taxi was going to happen for like the last 10 years. 10 years. It's finally, not even happening, actually, technically. There was no one in the car. And there was a Tesla having to follow behind this Tesla. So, keep in mind, this stuff takes a long freaking time. And in regards to Palantir, it's just, and I posted this inside my private stock group yesterday. I said, even under my Palantir bull case, it's starting to get hard to see much for gains in the stock over the next few years. Because under my bull case, I have them growing revenue 45% in 26. 40% in 27, 35% in 28, and 30% in 29. And I had them doing 10 percentage points better net income growth each of those years. So under my bull case, my compounding annual growth rate, and that's an 80 to 100 PE we're even talking about with this stock, even under that very bullish scenario, lucky if I can get low double-digit gains in the stock. And that's a bullish case. My base case, I'm not even going to make money in the stock over the next, 5 years. And so, this is where you got to look at stocks like this, and you got to say, it makes sense to take some profits this summer. And the further Tesla moves up and the further Palantir moves up, the more it means to take profits. Because at the end of the day, if you're a long-term investor and you're planning on being investing in these stocks over the next several years, you just start to look at them and you're like, it doesn't make sense. Like it could be 3, 4, or 5 years down the road and you still won't have made any money from where these stocks are trading at in the summer. Unless magically just, but I can't even say like magically growth rates get even better because they've already priced that in. That's the craziest part. It's even if the businesses get exponentially better, it's already priced it in. That's the thing you gotta understand. So, it makes a lot of sense to take some profits this summer on those stocks, and especially the more risk on the market goes. Now, that might lead you to a question like, when's the time to hedge? We've been in roughly a 32-month bull market. Let's assume we break these all-time highs this month or early next month, like what happened in 2018, right? And then we just blow through those all-time highs in August, September, right? Well, when's the right time to hedge? Here we go. I would say best case scenario, this market continues to go risk on, right? And then you can start to enter some hedges kind of in August, September, and then maybe October as well. And probably do those hedges where it's put options that expire at some point in 2026. Maybe it's like the first half of 2026, maybe it's the second half of 2026, right? And so that's kind of what I'm looking at here. But we need the VIX dead. The issue is right now, and I'm looking at put options, you have to pay really big numbers right now for put options on all of these stocks. And the reason being is a lot of people hedged like crazy back in March and April, right? Because they thought the market was going to crash and it was just going to keep going down. So the VIX spiked to ridiculous levels. So what you're having now is the people that are selling these put options want too much money for them, because they probably paid really big numbers for them and they're having to take losses. It reminds me of the housing market, right? The housing market over the last few years, you're looking at some of these homes that people have been listing, it's like they want way too much money for that and the homes just sit on the market. That's what I'm seeing with put options right now. People want way too much, right? If we can go more and more risk on this summer, right? People are feeling better about the market. Things are looking better. The IPO market keeps rolling in. You're starting to see IPOs now, and these IPOs are flying to the moon. That's going to lead to more of a good feeling around the market, which leads people to say, F puts. I don't need puts. I don't care about puts. No. And that leads people to just sell puts at whatever they can get for them. So if we can get the VIX dead, right, which is already starting to die a death, but if we can get that baby to die, we could be looking at put options this summer, or let's call it late summer or early fall time that could be very attractively priced then at that point in time, right? And these hedge fund managers, they're already starting to kind of look the other way on bad news. The more they do that, the more they're not going to care about their puts anymore. And that's when we can scoop up some of these put options for very attractive prices. And you could be able to hedge $1 million portfolio for probably $10,000 of puts, which is 1% of your capital invested. And then you could have a great deal of protection in case this market tanks at the end of this year like it did in 2018. Or in case the big recession hits next year, something like that, right? You'll be well hedged just in case. And I'm telling you, if the VIX dies and these fund managers stop caring about puts, you're going to be able to get puts for pennies on the dollar. And you will be able to hedge a portfolio to a very high extent with only 1% to 2% of your capital. And here's the thing, if the market was to go south, let's say the market did deteriorate at the end of this year or early next year, right? Suddenly that $10,000 could grow to be $50,000 or $100,000. Because when the market starts to tank, put options don't just go up a little bit. Like you all of a sudden start to get some 100%, 200%, 400%, 600% gains on those. But got to get them at the right price. Pricing is very key. Timing is very key whenever you're hedging. Just like I had some Tesla puts, what was that, a week ago or so. I made over 40% on those in like 2 days. What did I do? Did I keep them and say, you know what? It might go down more. So no. Out. Took my profit and I ran. Peace. I'm not staying around for that. I'm not going to get greedy. You gotta get that part right, man. Because if you try to get too greedy, I would have ended up with put options that were worthless today versus a 40% gain, right? Alrighty, so what are some stocks I'm looking to buy on Friday? Hope you guys are enjoying this video, by the way, and I hope you're learning a little bit from it, okay? I'll try to teach you guys as much as I possibly can. So some stocks I'm potentially looking at buying Friday. Nike comes to mind. Nike's still very attractively priced. I really like that stock a lot, regardless of where this market goes over this next 3-6 months. EL is still like that one. Win still like that one. Anytime Win's under 100, I really like it. Anytime it's under 90, I really, really like it. Anytime it goes under 80, rubbing my hands together, baby. And this is a part of the market that it has not really moved to the upside yet in any substantial way. Like, yeah, these stocks have moved up since the bottom, but it hasn't really moved like that. I think, here's the thing, if you get these fund managers to feel a little better about the market, a lot of them will look to a lot of these sorts of companies because these are the ones that have more consistent business models. They have good turnaround stories. They've been well-established companies and things like that. So I wouldn't be surprised at all if those stocks, do very, very well. Google McDougal, definitely one that I'm very attracted by right now. PayPal is actually pretty attractively priced right now, and they're actually making a lot of innovations on the Venmo side. Not sure how much you guys, I know I don't talk a ton about PayPal, but it's still a major position for me in the public account, for instance, right? They're making a lot of exciting moves on the Venmo side right now. I should talk about them more often, to be honest. But Google McDougal, that one is very attractive price, so I might buy that one. Celsius is actually still interesting, but here's the thing with Celsius. I actually took a little bit of profits on this one. I sold like 444 shares of Celsius. I just took a little risk off the table. This one has bounced heavy over the past couple months here. And I'm already sitting on $70,000 plus of gains on Celsius in the public account. That doesn't even account for the profits I just took on this baby. So Celsius is looking, pretty good. And it's still looking kind of like a buy, but I decided to take a little bit of profits on regards to this one. If this one went $50, $60 a share, I might take a wee more profits. If it wins 70, 80, I would probably take a bigger chunk of profits. But for now, I'm just kind of like, this 4,000 shares, I'm going to ride it for a while. But we go 55, 65 on this one, I'll maybe sell another 1,000 shares or something like that. Adobe's another one that's pretty attractive here. Look at the forward P Adobe, very attractive. SoFi's pretty attractive as well. SoFi, there is starting to be some hype building in SoFi. That could become a lot more hype. If the next quarter numbers are good and the guidance is good, I would expect more hype. SoFi is one of those stocks that's kind of like next tier down from like a Palantir bunch that a lot of people really like. They want to own it. It's just, you kind of need the market to broaden a little bit more. Russell 2000 stocks like SoFi do very well. But Adobe looks very attractively priced here. I like that one a lot. And I think they're going to be a net benefiter from this whole AI move overall. Like I haven't been somebody signed up for Adobe's products. I'm thinking about actually signing up for their AI product that's in the photo space. I'm probably going to sign up for that in the next few days actually, because from what I've seen, what they can do for generating AI related photos, it looks like the best of the best. It looks like the creme de la creme. And so I'm thinking about actually personally signing up for that, and I haven't even been signed up for Adobe's products before, so you might have a new customer in me for Adobe, right? Now, additionally, if you want to hear me talk more about stocks, I did this video 8 days ago, 4 stocks to buy now, June 2025 edition here on the channel, so if you haven't got to check out that one, looks like about 129,000 people have gotten to check out that one so far. If you haven't got to check it out, you might want to. Keep building, brick by brick, baby. That's all we do. We keep building stronger and stronger for whatever this market leads us, whether it's into a much more of a hype cycle here, a much more of a story mode stock market, which is what it's really, kind of brewing into, whether that means all to come crashing down, come later on this year, or come crashing down next year or 2027 or whatever. Regardless of however the cards play out, you want to build a great portfolio that can get through any storms, right? Out to the other side, okay? Appreciate you guys joining me for today's video. If you're looking to join my Patreon, that will be the second pinned comment down there today. It's also linked in the description area of this video. You get to see access to the stocks I'm buying, selling each week in the Patreon portfolio. Additionally, you get access to the Stock Hours Discord chat that's in there. And if you join on an annual membership, you save 16% right now. Additionally, if you're looking to, a little higher end group of investors with a lot of people with 6 figures, 7 figures, multi-7 figures, 8 figures invested, you want to be part of my private stock group, that will be the main pinned comment down there. That is also linked in the description area. You can fill out an application to join in there. Patreon, you can just join, sign up for that. For my private stock group, you have to actually apply to join there, okay? Alrighty, much love as always, and have a great day.